Hi everyone, and thank you so much for watching this awesome live session that we're about to have with Greg Campbell. I'll just give a brief intro and I'll let Greg introduce himself. Greg, we actually met Greg at a co-working space and we rudely interrupted his work day, and because we were so interested in learning from him, we had heard that he is a very successful investor and he also has experience in the podcasting world. So we were like, oh my God, we need to talk to this guy. So all of that was planned, by the way. We had it all planned. We strategically sat close to you and said hi. So now the secret's out. But without further ado, I'll let you, Greg, go ahead and get started and introduce yourself to our viewers.
Well, hello, ladies. I am very proud and happy to be with you this evening. And now I know the truth that you basically hijacked me sitting around in that co-working space. I was minding my own business. You guys talk, and then next thing I know, you have me in the middle of your conversation. And then the next thing I know, you're circling me and talking about your business. And then the next thing you know, I'm on your show.
That's right.
Very strategic.
Well, I know that you are focused in on immigrant entrepreneurs. And like some of your listeners, I'm first generation in this country. My parents are from Jamaica, and I have been an entrepreneur for the last 30 plus years here in the United States, doing business in the United States, in South America, in West Africa, and other parts of the world. So it's interesting to be sitting down here talking to a community that's very much like me.
Absolutely. And Greg, when you started your work as an entrepreneur, what were the areas that you were mainly focusing on, the businesses that you created and the businesses that you were running?
Well, I started off, my first business was I actually became a management consultant. I left corporate America after a number of years within the PepsiCo organization, and was looking for what I could use to translate what I had done in my corporate life into an entrepreneurial environment, and management consulting became the thing that I focused in on. And that's how I got started. And I built a consulting firm from myself up to about 27, 28 people, and doing work all over the country in a variety of different areas and industries, working with middle market companies and large corporations, and then spending a lot of time in the evening helping to coach small businesses along the way and help them raise capital and do all those wonderful things that we do as entrepreneurs. So that's how I got started, and that led into a real estate development firm, and that led into a private equity fund, and that led itself into creating with some other partners a private merchant bank and building education companies in the United States and in South America, and then to another company that I founded here called HBCUsOnline.com that helped, as an ed tech company, help historically Black universities get online. And then for the last several years, I've been just basically advising and investing in companies that fit three criteria. They're disruptive, scalable, and noble in purpose. So those are my criteria, and I get a chance to both be interactive with investment and advising. So it's been a lot of fun.
Awesome. And you kind of like opened a way for us to dive into our questions. And again, tonight we're planning on covering mostly the topic of fundraising, and we want to hear what your view is since you're an investor. A lot of times entrepreneurs don't get to hear what investors are really thinking and what they're looking for when they're investing in startups. So it's really awesome to have you here. Now, you mentioned three criteria that you as an investor always look into any startup that you're thinking about investing in. So tell us, give us a breakdown of what each one of those items really mean to you. So
I'm glad you asked that, because many people get confused by those criteria. So for me, I'm looking for businesses that are, I say, disruptive. They're trying to change the rules of the game in their industry. They are creating an unfair competitive advantage that they own in their industry. So they are changing the way business is being conducted in their industry. And that is very attractive because it means that they have unfair competitive advantage and therefore they should be able to generate huge profits in their industry. Secondly, I look for businesses that are scalable. And what I mean by scalable is they can go from their startup geography, their startup territory, to a national or international business fairly directly. So that once you prove out the business model, we just have to add the fuel of capital or people, be able to expand it on a national or global basis. And then finally, one of the areas that is most important to me is that it be noble in purpose. And by noble in purpose, I really look for businesses that actually help us as human beings, that help people, that contribute to the way people live. And that has been a good guidance and criteria for me because it helps me focus on the things that are really positive as opposed to things that would be easy to do. It's very easy to make money in a whole bunch of other areas, but sometimes it's more difficult to figure out how to do good while you're making money. Right.
So you wouldn't invest in a slime making company. You know what? Have you seen those slime videos that went viral for a little bit? Yeah. It's like, oh my goodness.
So I'm looking for companies that have all three. Right. It's difficult to put all three of those criteria together, but those are the types of companies that I look for. And sometimes they're in big packages, sometimes they're in small packages, sometimes they're at a startup level. Mm-hmm. Cool thing that I get to do as an investor and an advisor is if I'm going to invest, you also get me. Mm. So I'm going to go hang out and spend time and follow my money in the deal.
It's really incredible to hear from somebody that was an entrepreneur and also so you understand the struggles and the challenges.
Don't make me a has-been, please.
Yeah.
Continue to be considered an entrepreneur. Once an entrepreneur, you're always an entrepreneur.
You understand how it works being an entrepreneur, the challenges as well as the difficulties that they go through. And in your case, because you also kind of have that, the immigration part of it is also something that you can maybe relate to a little bit. Can you tell us a little bit more about the criteria of maybe personalities and the characters from the entrepreneur side, the actual founders that you see and you're like, oh my God, this person is going to make it big. Maybe not necessarily on the product side because product could change, the service could change, but what are you looking at when you're looking at the person, the founder, that entrepreneur that you're meeting with?
Great question, because it's actually a series of contradictions. I'm looking for somebody that has full confidence in themselves and what they're doing, mm-hmm. but at the same time, they have humility.
Yeah.
That's a very unusual package to find. Why the confidence? Because most of the times when an entrepreneur is doing, nobody else is really thinking about or really understands, and that entrepreneur has to have confidence in what they're doing, particularly when they're disrupting an industry. Okay. Think about the people who have, think about Uber when it got started. People are saying you're going to have regular people pick up other people and charge them, and it's going to be done via some kind of platform. That's a big leap of faith. So you got to have a high degree of confidence. Mm-hmm. At the same time, the entrepreneur needs to be humble because even though they have that confidence, they think they're right, they got to be open to other ideas and other influences to be able to pull together a team, be able to shape their business, and also to be successful.
Mm-hmm. Yeah, very true. What did I cut you off, honey? I wanted to.
Go ahead.
So I know a lot of times for a lot of people, a lot of founders that are just starting up, they start thinking about possibly asking for money from family and friends as early investors. Mm-hmm. What are your thoughts on that? Because I have mixed feelings about that just because I would be so uncomfortable if I had. I mean, not that
okay,
everyone's money you're taking.
Stop right there. The money that you initially get for your startup business is either going to come out of your own pocket or the pocket of your friends and family. We call it friends, family, and fools. That's where the money's going to come from. It's in your pocket or some of your family and friends. And they're not really investing in your business. They're investing in you. Because you really don't have a business yet. You got an idea.
Right.
You're getting something started. So even though you might feel uncomfortable making that ask or pulling the money out of your own pocket, get over it. Because that's where it's going to come from. And there's a very important reason why it has to come from there. Since you don't have anything yet, imagine you come to me with a concept and you say, hey, this is what I want to do. And I want to, I want $50,000. I'm going to say, okay, give me 95% of your business. Because the only way I could ever, if you're successful, the only way I could make back my money is to be able to have a very large proportion of the business. So I urge people who are starting businesses to leverage their savings, leverage their family and friends, and anybody else that they can bring into the tent to get the money they need. Which brings me to the next very, very important statement, and that is things that you should think about when you're going to raise that initial amount of money. First and foremost is, how much money do you really need? And how long will that initial money last? Because I've seen a lot of startups who make a terrible mistake about getting too much money too early. And it's either squandered because they don't know exactly directly how to invest it because they haven't proved anything yet. They haven't proved out their business model. Or on the other hand, they get money and let's say they are going to be successful, but they get money at such an early stage, their valuation is so low, so that $25,000 that they got, basically they sold off, a third or half of the company because the valuation was so low. Not a good idea. Make sure you know how much money you need and how long that money is going to last. Also, understand what type of money you need. Do you want to raise debt or equity or some other hybrid? And we can talk about some of the hybrids in a moment. And make sure that you understand the consequences of raising debt or equity. I keep on preaching, you're going to hear me say this very often, that is valuation, valuation, valuation. Why is that? Because the entrepreneur at the end of the day really wants to have a liquidity event. They want to walk away with something. And if you give all your equity away at the front end, you got nothing at the back end when you do have a big payday for the company. So valuation, valuation, valuation. So anytime you're raising money, one of the things that should be right in front of your head is, at how much money do I want to raise at this valuation versus could I put off raising, half of the money I'm thinking about for a future date where my valuation may be slightly higher and I have to give away less equity. Make sense?
Yeah,
absolutely.
That's a really great point. So more is not always better when it comes to raising money, and be sure you have your number in mind and what you're going to do with it exactly before you get into it. And
figure out what flavor money you're going to raise.
Right.
Debt or equity. If you raise equity, you're diluting yourself. If you're raising debt, you may be paying a high price for it, but it doesn't dilute you.
And Greg, when you're talking about equity is probably the hottest way of raising money, at least in Silicon Valley, that everybody talks about equity, and it's just really hot in terms of way of raising money for some reason. I don't know why, but who would you say equity is for on top of your head if you're thinking about a product or a company that's getting started? Is there a way to say, okay, this company has to raise equity versus other channels?
There are two times when I say equity is the absolute way to go. And that first way is if you believe that your company is going to go through a very limited number of rounds of fundraising. If you're doing 1 or 2 rounds, you can raise equity because you're not going back to the well multiple times. The second time, or the second time where you consider equity as the basis way for you to raise money, is when you get into the second and third rounds of raising money, because that's when the investor on the other side is not interested in putting in debt, because they want to participate with you in the liquidity event that you hope will happen 5 years from now or 7 years from now, whenever you think it's going to happen. So they're interested in getting a piece of the pie. So you get beyond the friends and family round, you get beyond the seed round, you get into a Series A. You're usually looking at some form of equity or equity-like instruments. So those are the two times. I say absolutely that you do look at equity. Most of the other time, I start pointing entrepreneurs in the form of other types of equity or other types of investment vehicles. So when I'm thinking about a early stage friends and family round or a seed round, I am usually saying, hey, take a look at the balance between putting that money in an equity where you have such a low valuation versus putting that off. See if you can't use some of the other vehicles. One of the most prevalent vehicle is a convertible note that allows the investor to put money in today and then get a discount to the next round of equity raise, Series A usually. A takeoff of that is the SAFE. You may or may not have heard of the SAFE. It's called the Simple Agreement for Future Equity. It performs fairly similar to a convertible debt, but it's not debt. It's sort of like a contract that basically allows the investor to sign off on a SAFE, participate in the next equity round, but it doesn't sit on the balance sheet as debt per se. Another consideration might be sub-debt, where you might be able to raise a small amount of equity and get the rest in sub-debt. So that's another opportunity. And let me give you two other ideas. First of all, if you have decent credit and you have some collateral, go to the bank. The bank is going to be cheaper than any of these sources. So if you have some property, if you have something else that you can leverage, don't sell it, leverage it with the bank. And then finally, something that many entrepreneurs take advantage of is that they do some vendor or customer funding. So they find a way to talk to their vendors and say, hey, listen, I need working capital. And if I can get your if I can get your products to be able to sell through my company and you give me long enough terms, I'll be able to pay you back. And that's a way of not having to go out and borrow money or get equity to fund your inventory or the work that's being done in your company. Sometimes you can work with customers who will advance you money so that you can have the same kind of situation. Again, both of those are wonderful because they're non-dilutive. They're not diluting your equity stake in the business. They are simply just some tools that you can use, creative tools that will help you fund your business without having to take out a note or raise equity.
Yeah, that's really, those last two options. Go ahead.
One other one I forgot, and this one is very, very important because this just came up in a deal that I'm involved in. Government grants.
Oh, that's a good one.
And this is sort of amazing to me. I'm working with a company right now that out of the blue, we found out that there are grants available from the federal government that total millions of dollars, and you just have to go out and apply for them. So we're applying because if we get that grant for his business, basically he's getting the money he needs to get from stage A to stage B, and he's not having to raise debt or equity. He's getting a government grant, and he can perform the work for the grant, create the reports, and have the cash to do what he needs.
Oh, that's incredible.
Yeah, that's one of really those last three options seem to be like the least common, but the most logical way to go about it. At least, I mean,
if you can, yeah.
If you can, definitely you should go after those last three options for sure.
And it calls upon the entrepreneur to be creative.
Yeah.
And that's what I urge all of your listeners to be creative as they think about how they go about raising money.
Yeah.
Okay, so let's say the entrepreneur has figured out very creatively what types of money they're going to be raising. What are the best practices for founders to get in touch with investors? And, depending on what approaches the investor is comfortable with, do you feel like they should change their strategy to work with that particular investor down the line?
Okay, so here you have a balancing act. You come into, as an entrepreneur, you come into the arena essentially with what you believe is your business concept and your business model. And you're going to encounter investors who may say, hey, I don't get it, I don't believe it, whatever. Do you change? Do you pivot? And the answer to that is depends. If you are raising money for the last 6 or 8 months and everybody keeps on telling you the same thing, you might want to consider it. If you ran into one investor who's going to put a lot of money in your business, if you would just change, the whole basic concept of your business, go find another investor. Okay? So I usually say, how do you engage investors? Networking, networking, networking. It's all about getting out into industry groups where investors are going to hang out because they're looking for deals. If you think entrepreneurs are looking for investors, investors are looking for deals.
Absolutely.
So you got to get out there and do the networking with industry groups, trade shows, get in contact with the angel groups in your community. There are tons of angel groups across the country. Look them up and find out what kinds of deals they have invested in, because they tend to follow a particular niche. So some will do a lot of technology deals. Some will do healthcare deals. Some will do manufacturing deals. Find out your group that does what you do, and then apply, network, meet, nag, do whatever it is you got to develop a relationship. Because at the end of the day, what you want to do is you want to do warm calls, not cold calls. You want to be able to send your pitch deck into somebody who has already met with you and that you've had a conversation with, who's indicated, hey, that is an interesting approach to XYZ. Send me your pitch deck or tell me a little bit more about your business. That's where you want to go.
Yeah. And perfect that you brought up pitch decks, because my next question is on pitch decks. Give us your top 3 or 5 or however many you feel comfortable sharing best practices for pitch decks.
Number 1, and this should be 1 through 5, make it brief. So I'm going to tell you a little secret. Investors spend maybe 1 or 2 minutes at best on a pitch deck.
That makes me upset.
So you put in 50 hours doing your pitch deck.
Yeah.
And those who are investors may spend 1 or 2 minutes looking through it. So it's very, very important that it be brief and that you get to the point very quickly. In fact, after being brief, my second point is that you got to hook your audience on the first page of your pitch deck. Describe your business using as the fewest possible words. If you're a long-winded person, find somebody who is a good editor, because you need to be able to say what your business is, describe your business in as short a phrase as possible. Think about the fact that you got 10, 15 seconds to really capture that person's attention. And if it takes you a half a minute or a minute, they're not going to do it. They're not going to read it. They're not going to be engaged with it. So hook them on the first page. The next thing is let the numbers be a significant part of the story. So for instance, if you're opening a business, let's say that you're going to do a business that's about a podcast that's targeted to immigrant entrepreneurs. It's really good if you can talk about the number of immigrant entrepreneurs, the fact that you have already done some pilots and you've gotten X number of people already involved with just X amount of spending, and you're looking at getting some more money so that you can increase your crowd that results in these kinds of profits. Make the numbers part of the story.
Mm-hmm.
It's very, very important that you do that, because words, after you've read 10, 20 of these during the course of a week, don't mean anything. So make sure the numbers tell a story that captures people.
Mm-hmm.
A fourth area is brag on your team, because one of the most important things that investors look for is your management team. What does your management team do that particularly fits this opportunity? What experiences have they had? How are they connected? What do they bring as part of the special sauce for your business? Brag on that. If you're if you've been in the podcast immigrant entrepreneur business, help if you know a whole lot of immigrant entrepreneurs. Would help with the fact that one of the partners was involved in podcasting before or had a successful podcast. So those are the kinds of things that you would talk about, brag on them, because that captures people's attention. Because at the end of the day, when you think about what really makes an impact on the investor, it's not the sexy colored graphic pitch deck, it's the people.
Mm-hmm.
So those would be the key things that I talk about in terms of pitch deck.
Let's make this kind of fun. Tell us one presentation that you were completely shocked when you saw it, whether it was so great that you were just blown out by their creativity, or it was just horrible.
Well, I'm not going to protect the innocent, I'm not going to talk about the horrible one.
Okay.
There have been pitches where I just said, stop. Save us some time, save yourself some time, and save yourself embarrassment. Go away. So there have been those. But on the other side, let me tell you about some that have really impressed me. And most of them have involved the incorporation of their product into the pitch. So I was attending a pitch that involved a glove that you could wear that allowed you to control other devices by wearing this glove. So imagine we're sitting there getting this pitch, and the pitch is being controlled by the person basically touching their fingers, moving their hands in certain ways, flipping slides, moving other things that were part of the pitch presentation, all by being able to touch their fingers. So we're going, wait a second. I am now experiencing what you're talking about, so you got my attention. Okay? So it's being able to bring your product in. Another example of that is there was an alcoholic beverage product that was targeted to women, that the entrepreneur made sure that she was pitching women angels. And she went in there and said, when the ladies came in, they all had a glass of her beverage sitting in front of them. And she said, I'm not going to say anything until after you taste my product. They all tasted the product and they went, wow. And then they said, all right, now
tell me more.
Okay. And I'm going to give you a third one, which was a lot of fun, that incorporated the product. I got a chance to see a pitch that was about a recharging product for cars and buses, electronic buses and electronic cars. It was a mat that you drove over. So imagine, take your Tesla or whatever, what's the other GM product that is an electronic car? You just drive over this mat and your car is charged in 10 minutes fully.
Wow.
Amazing.
Imagine that. So we're at the pitch and we're asked to go stand out in the garage. This guy brings in the car, shows that it is basically has no power in it. They push it over this mat and no switches, no nothing, sits over the mat. And in 10 minutes, he is talking to us about his management team, and he says to one of the people who were seeing this presentation, hey, go in and start the car. The car was fully charged. Again, using your product as part of your pitch. It's a wonderful way to grab attention, because again, what you're trying to do is get the investor's attention. Because they see so many pitches on a given week that if you don't get their attention, it's just another presentation.
Wow. Is that product out yet?
It is another product that's getting a huge amount of government financing.
Yeah.
Wow.
I mean, just thinking about it, it's making the life of electronic car owners easier. So I believe that would definitely go in that, category of
the third category.
Yeah.
For you. Yep.
For sure. All right. So I have my next question is on, so we covered the fundraising basics, people knowing what they want, how much money they want, people knowing what kind of money they want, pitch decks. Now let's talk about exit strategy, which is very important, like tightly coupled with fundraising, because investors are always thinking about, when's my exit and when am I going to make this money back? So what do you think, at what point does the founder need to start thinking about an exit strategy?
I am so glad you brought this up. One, because it is very important to the investor, but it's also how entrepreneurs turn off investors very quickly. If the front end of your pitch is, I'm exiting this in 5 years, and this is how much money we're going to make, everybody says that and nobody believes it. Because you have no control over that. So what I usually tell entrepreneurs is that you don't think about an exit until you've built a real business. There's nothing to sell. There's nothing to liquidate. What you have to prove to the investor is that you have the ability to build this business. If you start saying, hey, I'm going to be out of it, the investors start thinking, hey, this person's going to jump ship as soon as possible, as opposed to when they've created real value. So demonstrate in your pitch, demonstrate in your interaction that you're about building real value with investors' money and time. And the important thing to think about when you start planning for an exit is, has the business and the business model been really proven? And is it achieving a significant run rate and returns? Because if it hasn't gotten to that stage, you're selling probably before it's really time to sell. So is the business and the business model, when I say the business, the team, the organization, all the things that you do, and the business model, how you make money, have they been proven out? Because if those are not proven, you're not going to get very much money for the business. And the most important question that I usually ask an entrepreneur who tells me, hey, I want to have a liquidity event, I say, why are you liquidating? Are you liquidating because you've achieved growth beyond your management team capabilities or the company's infrastructure? So you've gotten something that's become really hot, but in order to be able to take it worldwide, you really need a large corporation who has the infrastructure, and it would take you too long and too much money to build that or duplicate that infrastructure. It's time to sell. Are you seeing storm clouds on the horizon, and that's why you want to sell? Not a good idea, because if you see those storm clouds, so does everybody else, and they're going to discover it in due diligence, and you're not going to get anything for the business. When I tell people how to sell, is there still sizzle on the steak? Is there still something there that's sexy about the business? Is there still something there that people want to have? That's the time to sell. You've proven the business. You got an organization that's working. You got people in the key places. The basic systems of the business are working. The business model has proven out. You've been able to get money in the top through revenue and generate a return or profit at the bottom. And all you need now is to be able to put more fuel in it. and that fuel can come from another round of investment, or it could be through a strategic or a financial sale, go for it. But make sure that there's still some sizzle on the steak. Make sure you don't wait too long to sell, because that's the other mistake I see in entrepreneurs. They fall in love with their business. Now, you can stay in the business, but you got to make a decision. Am I going to be there for the long term, or am I there to get to a point where I've proven this business and I want to go do the next one? If the latter is your case, make sure you sell when it's appropriate to sell. The sizzle on the steak, the business and the business model are proven, and there's still capacity to really grow the business.
Is it fair to say don't be Snapchat or Yahoo?
Yeah, I would say that. I would definitely say that.
That's a good tip. That's a really good tip. And a smart entrepreneur should be able to know when is that hot moment. And is it going to get more hot, or is it going to just go down, and where they have to sell for way less? Kind of what happened to Yahoo. I mean, a corporation, but still Verizon purchased them for, Shazza.
No comments on that one.
Someone might see this video. Okay.
Yeah. Well, this has been really helpful. We really hope that our entrepreneurs and our audience can take these advice, see what makes sense for them, and make good decisions when they're trying to raise funds, because I think it's the most important, beside the idea and obviously the execution of the idea. It's probably the most important decision that they're going to be making without really realizing the investors they're picking as their, main investors, as well as the way they're raising funds. So we really appreciate your time, Greg, giving.
So, wait a second. I got 2 more tips to give you. Can I share
Yes.
some ideas?
Yes,
of course.
Absolutely. Give us more.
One of the things that I find that entrepreneurs are really not clear about is, what are investors really looking for when they're talking to entrepreneurs? And among the things that they're looking at, I mentioned this before, is the management team skill sets. Do they have the experience? Do they have the basic kind of skills to be able to run this particular kind of business at this particular stage? And this is a very soft skill, but as investors, we all sort of develop a knack for this. Trustworthiness. Can I trust this CEO, this founder, this management team to do the right thing, to make the right decisions? Because all of us know that the business plan that we're presented on day one is not going to be the business plan maybe even 6 months from now. Can we trust the management team to make the right decisions, to pivot, to shape the business model in new ways as we move down the road? Secondly, is the business concept truly disruptive and scalable? That's what we're looking for. Is it really, in my case, not only disruptive, scalable, is it noble? Is it really going to help people? Third, what are the competitive barriers? Is there intellectual property involved? Is there some geographic barrier that they are leveraging? Is it timing, being first to the market, that is helping this business? What's the competitive environment? Are there a lot of competitors, only a few competitors in this space? And then what are the returns? And where does this investment fit in my portfolio? So part of the due diligence that an entrepreneur needs to do is on the investors. What are the kinds of things are they holding? Does this fit into their portfolio, or is this an outlet kind of thing? So it's got to be something that fits into something that the investor knows about. So that's really key. Those are the kinds of things that entrepreneurs don't normally always remember to look for. And it's really, really important that they stress those elements with the investor. Okay?
But you mentioned that they need to see if what they're offering, basically the investor, fits with their portfolio. What do you mean? Is it the type of business that investor is interested in and is investing in, or
investors get into, their own boxes. So they may invest in healthcare, or they may invest in only technology related health. So you got to figure out, what has this investor invested? So when you meet an investor, you ask them, hey, what's your niche? What kinds of things do you invest in? And if I'm doing a restaurant business and this person says, I'm in healthcare, thank you. Do you have any of your friends, other angels, that are investing in restaurants? Because I'd be wasting my time and wasting the investor's time trying to convince that investor to invest in my business.
Right.
The second thing is, what stage do you normally invest in? So do you invest in very early stage businesses, or are you more of a Series A investor that likes to come in after the business model has been proven? Those are very important questions that will get you a lot of points from the investor, because then you've just demonstrated, I'm not going to waste your time. Okay? And then the other thing I want to talk a little bit about is, what should you expect from an investor?
Yes, that's a really important one.
And that's when I talk to people about, entrepreneurs, about, some money is greener than other money. So you want the greenest money possible. What I mean by this is, what else do you get besides cash?
Right.
Some investors can really help the business in addition to investing money. They can potentially help you access customers and vendors. They can help introduce you to other investors for future rounds. They can help you with personnel needs, team needs, other support services, accountants, lawyers, developers. They can be mentors for your management team. They can also serve on your board. So when you look for an investor that's going to be able to put more than just money into the deal. Okay?
Yeah.
I want to make sure I got those 2 points in before I left you.
Those are great tips. Thanks for sharing. I'm sure our listeners are going to get tons of value from all the tips you shared, because it helps. It helps when it's coming straight from investors. A lot of us, when trying to raise funds, look to other entrepreneurs and people that are doing it with, have gone through it, and it's not directly coming through investors, because a lot of us are maybe intimidated by going up to an investor, not asking for money and asking for advice. So I think this is really helpful to get your voice out there and make sure that entrepreneurs are hearing this coming straight from investor to founders. We really appreciate it.
And if I can be of any help to your listeners, you can hit me on social media. I am Greg Campbell. You can find me just about any place on I am Greg Campbell. So you'll be able to find me. And the name of my company, again, is Rainmaker Inc. And you can reach me at rainmaker-inc.com. That's our website. So we'll look to see if we can help any of your listeners. And thank you for this opportunity.
Absolutely.
Thank you so much. And we'll be sure to share all the links in the description whenever we share this episode.
Well, thank you very much. Have a wonderful evening. And I look forward to seeing you both soon.
You as well, Greg. Thank you.
Thank you so much.
Take care. Bye-bye.
Bye-bye.